Good morning, good afternoon, good evening, wherever you may be. This is Sid from Elliott Wave Plus, and this is the April 26th of 2022 edition of our quarterly premium plan webinar, where I'll be going over many of the specific aspects of our premium plan. It's our flagship plan here at Elliott Wave Plus. And before we get started, I'd like for you to be aware of our disclaimer. Our disclaimer is available all the time at our site, elliottwaveplus.com. You go there and scroll to the bottom of any page on the site and click on this Terms of Service Disclaimer tab. And there it is. It's there all the time. Please go there and read that in full. If I were to summarize it in one sentence, it would be, there's risk of loss in all trading. There's some other required statements in that disclaimer as well. Feel free to go to the website anytime and read all about it. Okay, let's go to Trade Navigator. We've been doing our premium plan here for several years at Elliott Wave Plus. And here, allow me to turn off the video of myself so you can see the entire screen. So we've been at it for several years, and most people think that primarily our premium plan is about automated trade signals on daily charts on about 20 popular tradable items. Those items, just so you'll get a quick refresher, I'll give you a quick list of those here. So if you are a premium plan subscriber, you go under nightly reports, and if you are logged in at the site, as I am here, it'll bring or put all kinds of choices underneath these tabs up here. And one of those choices is premium plan nightly algo reports. Matter of fact, if you're in the premium plan, you get absolutely everything we do: the biweekly screenshots, weekly webinar, accounts webinar, our daily trend reports and crypto automated signals on cryptos, as well as our premium plan nightly algo reports. So we're going to spend all of our time this evening on the premium plan and what it brings. So this nightly algo report was just published a few minutes ago, and it's for April 26th. And you can see that there's a tremendous number of screenshots that are made available to you every night of current conditions in the markets, and then a summary report. The summary report shows you and it color codes any new signals or action items from the algo. And it looks like on crude oil, there was a limit sell signal that was stopped out today, and it's gone back to a flat position. Also, on the Canadian dollar, there was a sell signal yesterday, quickly stopped out today, and no other action items there. And that's also included in our summary report every night are the updated weekly current Elliott wave count on the specific items, what the Hurst cycle analysis is considering on each item, and what if there is a DSI, daily sentiment index, if it is covered by DSI, then it gives you the current value at the close that evening of the daily sentiment index. So in the case of the ES contract on the S&P 500, it closed at a 17 last night, which means that 17% of retail traders are currently bullish. So a lot of bearishness in the market right now. Only 12% of retail traders are bullish on the NASDAQ currently. And the reason that's important is very many times retail traders are way on the wrong side of the boat at major turns in the market. So that's the reason we track not only retail sentiment, but a lot of what we're going to talk about today is our new and improved sentiment conditions screenshots on a bunch of items. We'll be talking a lot about that, and a lot of the information there on those screenshots is coming from the commercials traders and their positioning. We'll talk a lot about that as we move along. But you can see these are alphabetized. We've got a chart of the AMA algo. That's the signal, what brings us the signals on the Australian dollar, as well as sentiment conditions on the Australian dollar. Same with the Canadian dollar. Same with crude oil, German DAX, Dow Jones Industrial Average, emerging markets, leverage, long and short gold miners, the euro, GDX, gold miners, gold itself, banking sector, the NASDAQ, leveraged ETFs on the NASDAQ, long and short, the Russell, and then we also have leveraged ETFs on the Russell, long and short, as well as the S&P, long and short. Silver, the S&P, obviously, US dollar index, XLE, the energy sector, large cap oil stocks, basically, and the ZB contract on bonds, the 30-year bonds. So all of those are included every night. The great majority of them have, except for the ETFs, are going to have not only automated signals, but an additional screenshot called sentiment. And so we're going to set that aside for a minute here. And we're going to go over a quick explanation of our algo and how it produces automated signals. So I'm not going to take very long on that because I've explained this quite a few times. We continue to make little tweaks and improvements to the automated signals that go out every night. They're based on a momentum, not on Elliott wave. They're not based on Hurst cycles, but they do consider extremes on DSI currently. And if the DSI is too extreme, it won't take the trade. For instance, the DSI tonight, there it is right there, 17% of retail traders are currently bullish. That's a pretty low number, although it can go lower, like right back here on February 24. It went all the way down to 10. And so what we do is we back test and look for thresholds on the DSI. And the back test is currently telling us, a 3-year back test, that if the DSI is below 6, then the algo will skip any new sell signal. And if the DSI is above 87, if more than 87% of retail traders are bullish, then the algo will skip any new buy signals as long as that condition is in place. So it is a way to filter out signals, and it uses the very, very extreme bullishness or bearishness from retail traders as a filter. And the idea there is if retail traders get down into single digits, like below 10, taking a new sell signal typically doesn't work out very well based on backtest, 3-year backtest. Okay, so that's one way that our automated trade signals do consider sentiment, but it currently isn't everything that a person needs to know in order to trade the markets when it comes to sentiment isn't completely in the current bullishness or bearishness of retail traders. Really, the most important entities and the ones that we want to make sure that we're completely aware of their current positioning in the markets, whether they're positioned bullishly or bearishly, is the commercials. And for that, in order to get the commercials, go to the sentiment on the Dow Jones Industrial Average YM contract now. In order to get the commercial sentiment, we have a separate screenshot on all of the futures contracts, which include the YM futures contract for the Dow Jones Industrial Average and the ES contract on the S&P all the way down the line. We have a template that we call this our sentiment conditions template. And it looks very heavily and depends very heavily on commercials positioning. So who are the commercials? Commercials are essentially large entities that use futures and even options on futures to hedge their business interests. So take, for example, a large gold mining company. Let's just throw an example out of Newmont Mining. Newmont Mining has on staff people that their job is to protect the company's interests. Well, Newmont, what they do is they mine gold and sell it. And so as long as gold is generally moving to the upside, when they hedge, they're protecting themselves from a downturn. And the longer that a trend goes, the more heavily hedged they become. And the opposite is the case. If gold is dropping in price and has been trending down for a while, a company like Newmont would be more interested in taking their hedges off, because all trends eventually come to an end, become extremely stretched, and reverse. And so you would see evidence on the gold chart, on the gold sentiment conditions chart, of how a company like Newmont is very likely positioning themselves in the market. This is extremely important information, as these are the smartest gold traders and positioners and the researchers into the gold sector, mining sector, that there are on planet Earth. And so we want to be very aware of what they're doing. And that's why we have three different indicators on our sentiment conditions chart that representing how commercials are positioning themselves on the short term, on the intermediate term, and on the longer term. We'll get to that in a minute, but I just wanted to show how important it was that this sentiment conditions template, and we've been working and trying to perfect it for a while, and it's amazing what it is able to do. And we've almost got it to the point where on some items, especially commodities that must be produced, stuff like metals, oil, grains, those things have to be produced, and they're very tangible. Now, we also produce we're commercials positioning on items that aren't quite as tangible, like stock indices, bonds, and currencies. although there are definitely commercials involved with those as well. So we have these sentiment screenshots on all of those things. And we're going to get more into the brass tacks of how these what these three indicators here are telling us, as well as the retail sentiment indicator, and how those are showing some of these colored boxes up here and how to interpret those. So we're going to go into that shortly, but I wanted to define who commercials were and how important they were before we get to that, and that's going to come just a little later. And for that example, I'll use several examples, including getting back to the Dow Jones Industrial Average. I do want to finish just a little bit more on the algo, though. So what the algo does is it is an indicator-based system, and there's several key indicators on the algo chart. One is the adaptive moving average. That's an indicator devised by Perry Kaufman, and it has settings, 3 of them. 2 of them we backtest for. One of them, the 30, Perry recommends just keeping that at the 30 all the time on everything, so we do. The others are basically how close it hugs to price. And at the same time that we backtest for the settings on that, we backtest for the settings of a moving average of what I call the Walter Bressert indicator, which is a double smooth RSI. So it's a plain RSI, and you take a 3-period moving average of the RSI, and then you take another 3-period, you take an additional 3-period moving average of that first 3-period moving average, and you get a pretty smooth, a double smooth RSI. And Walter Bressert had written in his writings, had talked about, then you want to make a moving average, a simple moving average of the Walter Bressert, and look for crossovers. And those are very meaningful in a number of ways, but it's amazing how often that those occur at or very near a shorter term trend change. Like you can see we got a crossover of the Walter Bressert right here, and it created this green block, which also is duplicated up here just below price. And that at that point, price did reverse and move up for several days. Look at this Walter Bressert here, and very close to the top tick of what was of this peak up here. And so we went from this Walter Bressert down to this one, so on and so forth. So what the algo does is when the slope of the adapting moving average and the current direction of the last crossover on the Walter Bressert are the same, then it will enter in on a trade. So for instance, the adaptive moving average started sloping up right here. And so we got this Walter Bressert, the block, because there was also a crossover, a positive crossover of the Walter Bressert over its moving average. And so those two things together created a buy signal. It bought at the open here, and it stayed with it until it got a Walter Bressert again, which means it was detecting a loss of upward momentum. And that green block right there represents a winner, a winning trade. This was also a winning trade here on the short side. This was a big winner on the downside. So how big are some of these winners? That one, trading one ES contract at a time, was a $13,000 winner. And you'll notice that the S&P, the ES contract, the Algo and the ES contracts have been doing very well. Had all the current back-tested settings been in place for the last 3 years. And I can tell you there's subtle changes every quarter to those, but not that big of a deal. It would have taken a $18,300 account and packed on $115,000 additional dollars over a 3-year period, and that's trading just one contract at a time. And the reason I'm showing the S&P, you can see all the green winners. The red blocks are the losers, and it's just been doing a fabulous job of finding the spots where there's enough momentum that it is likely to continue a bit further enough to produce a winner. So there's a number of parameters of stop size, whether to use a trailing stop or not, whether to use a different size stop for longs and shorts, thresholds on the DSI, when to avoid taking a signal. And then an additional aspect is when you get an extremely long signal candle, like we did right here, it looks, if it's unusually long, it will look for X amount of pullback based on backtesting before it jumps in on that trade. In this particular instance, it didn't pull back enough to take the trade. Same back here. This was a larger than usual candle, and it didn't pull back enough ticks to take the short. So, and it has to do it the next day. If it doesn't occur the next day, it's the original signal is null and void. Okay. So when we take this, these are all back tested and optimized over a 3-year period. We can see that it brought in the $115,000 worth of profit over 3 years, the last 3 years during the back test, starting with an account size of 18,305. And it actually put up a pretty good winning percentage. A lot of times the winning percentage doesn't have to be that much above 50%. It doesn't even have to be above 50% with this system in order to bring in profit. But in this case, and this is really the best back test we had of all the 20 items we send out signals on this quarter. It was the best of all of them, 62.6%. But the real key is that the average winner was $2,869, and the average loser was $1,429. That's about half. So the average winner is about twice what the average loser is, and that is the key to the success. So here's the equity curve over the 3-year period. The account starting down here, this is how much profit it was packing on to that original, what was it? Something like $18,000 account. And you can see that the worst drawdown it had was way back here years ago. It's a really nice, smooth curve to the upside. It's doing a very good job. So all of the algos that we show on the nightly report, on a quarterly basis, we'll take the results of those algos. Number of trades over that 3-year period, number of winners, number of losers, the average winner, the average loser, the winning percentage, the net profit, the all-important return on investment. That is, takes the minimum account size to get started, and how much actual percentage gain there was over the 3-year period. You can see these results are fantastic. On the S&P, not so much on some of the items down here. For instance, emerging markets, only 40% winners there. Bitcoin has dropped off, only 39% winners, so on and so forth. But the real, the most important category is return on investment. And you can see that this is a live sortable spreadsheet. So I can go from worst to best on return on investment, or I can go over here and say, show me only items that have the fewest number of consecutive losses. It's human nature. If you turn on, or if you start taking these signals, if you have to put up with too many consecutive losses, you're liable to give up on it before it really starts putting together a nice run. And you can see that the top three choices out of the 20 different algos that we send out nightly signals on are the US dollar index and the S&P. So no more than 4 consecutive losses on those. And if you really look at the S&P, there was at least one time in the last 3 years where it put together 10 consecutive wins. So the S&P, the ES contract, the most popular trading instrument in the world, was in fact the winner. And in recent years, it's almost always either the ES contract or the Dow Jones Industrial Average. So I'm going to go back to the return on investment. This spreadsheet, we would be happy to email to any of you that email us and ask for it. We will also post it in our next blog post, and we'll give you a link to download it. It's in full Excel format. You'll be able to sort it in a number of different ways and decide what you think is the best item to trade currently. And it's almost always either the ES contract or the YM contract, but who knows? It used to, back a couple of years ago, it was Bitcoin. Maybe even less than a year ago, it was Bitcoin. So back to this very quickly. So you've got some important indicators on here. I want to very quickly explain a couple of more of them. The daily sentiment index is on every algo chart. And if the daily sentiment index is not available on that item, and a perfect example is right here, the Dow Jones Industrial Average YM contract, there's no DSI published on this item. So on those items, I have come up with an indicator that does a fairly decent job of mimicking the daily sentiment index. It's not perfectly exactly like it, but it gives you similar valuable information. So this kind of lets you know, that black line there, what retail traders are thinking. Amazingly enough, retail traders were pretty bullish just 1, 2, 3, 4, 5 days ago. And then we have, 3 out of the last 4 days are pretty negative in the stock market. Now, in the case of the Dow Jones Industrial Average, it still isn't very close to its low back on February 24. The S&P is closer, and the NASDAQ and the Russell actually made new lows below their March lows today. But anyway, in a glance, you can see very quickly what's been going on with the market. So now we have the Walter Bressett moving down. Well, I'm going to move back to the S&P now. And we also had here in a second, we also have the RSI right here, the black line, and we have overlaid on it the money flow index, which is a volume goosed RSI. So it's an RSI that takes into consideration of volume trends. And you can see that the money flow indicator on the Dow Jones Industrial Average and the RSI are very close together right now. As a matter of fact, the money flow indicator is ever so slightly higher than the money flow indicator. That is potentially bullish, but usually it's going to be more bullish if it occurs down where these oversold lines are. For instance, right here, this was a very bullish condition. The RSI was in oversold territory, but the money flow indicator was not in its oversold territory. And by the way, 70 is oversold on the RSI. 80 is oversold on the money flow indicator. And for a little minute there, you got this dark green stripe, and that means that the RSI was oversold, but the money flow indicator was actually above it. And then the next day, they both moved to the upside, and it threw up this green stripe. This green stripe was created and automatically put on this chart by this comparison of the RSI to the money flow. And look how good that signal was for some upside. This one is also excellent. So was this one that occurred actually on February 24th. So there's a lot of really good indicators here to look at. So that's a very quick explanation of the algo and how it works. Now let's get to the main topic, and I'm going to work on this. So the rest of the webinar, and please send out your questions. Oh, Greg, to answer your question, Greg, the German DAX, each tick of the German DAX is worth an enormous amount of money. It's a huge contract. So here's an example of the sentiment conditions screenshot we just sent out tonight. Oh, there's one other quick thing I wanted to show you on the S&P algo before we get to the sentiment. So it plunged today, it had a terrible day, and it's nearing its that low that occurred on February 24th. But I want you to look at something. This is the Walter Bressert and the moving average of the Walter Bressert. The streaming is off right now. So this is how the market closed. The futures candle for Wednesday. No, today's Tuesday. Closed right here. Oh, that brings me to another point. Tuesday is when the weekly COT report comes out showing commercials positioning. And I have double checked this with Trade Navigator, Genesis, which is my platform. Genesis Technologies is a trade navigator. And they do include the COT's new weekly stats upon the close on Tuesdays. So what we're going to be looking at when we look at the sentiment conditions charts today is going to be fresh data that just came in today. It's going to be as updated and on the spot, up to date as it possibly can be. That's one of the reasons I wanted to hold this on a Tuesday. But so I'm going to turn on the streaming and just take a peek at what might happen tomorrow. There's no guarantee of what's going to happen with tomorrow's candle and with the indicators, but this will give you a quick idea of what might occur tomorrow. You can see that ever since the close of the futures market here on Tuesday, a new candle has started. It's the Wednesday candle. And if this candle can continue to bounce or close at least at this level, we're going to get a Walter Bressert, which means that at least on the S&P, that the Walter Bressert is suggesting that we already may be losing some downward momentum. I think it's pretty interesting. I'm gonna turn the streaming back off now, and now we're going to go back to the sentiment conditions screenshot for the Dow Jones Industrial Average. Let me just say that it's real easy to understand who a commercial is when they are dealing with something tangible. It's a little less tangible when you're dealing with stock indices, but it's still meaningful, and this chart proves it. So there's several indicators that are on every sentiment conditions chart. I already mentioned the fast, medium, and slower acting indicators of commercials positioning. And if DSI, Daily Sentiment Index, is available, it'd be down here. In this case, it's not, so we use synthetic retail sentiment, my indicator that sort of mimics the DSI. Then additionally on this chart, you have a 260-day simple moving average on daily chart. That is essentially a 12-month moving average. In other words, if this were a monthly chart and you had a simple moving average on it set to 12, it would be fairly close to what this is showing right now. And so this is showing that the trend has been up. The trend has been up, and it seems to be flattening out right now. And price has really, for the first time, dipped below that line back here in mid to late January, and it's been below that line more than above that line for the last for the entire first quarter, and now on into through April. So the long-term trend is iffy. It's no longer perfectly clear that we're in an uptrend. It's more of us, and it's not perfectly clear either that we're in a new downtrend. So this could be just a sideways consolidation that we're getting right now that you would get, for instance, during a wave 4. And so that I leave that on these charts to give you an idea of long-term trend. And then you see these gray or brown stripes here. Those brown stripes appear on the daily chart when the ADX indicator moves above 60. So there's the 60 line right there. And it was above 60, and that's why I put up a brown stripe here. It did it again here, and that's why there's a brown stripe, and did it again here, and that's why that brown stripe is there. I don't leave the indicator on the chart down here, and the reason is because it's that indicator, in my opinion, is the best information it can provide is on a daily chart. If it is above 60, that means that the trend, no matter whether it's an uptrend or a downtrend, is overdone. It's overextended. So right here, obviously the trend was overextended to the downside. Same here, same here. We really haven't had the trend, and the trend was obviously heavily overextended to the downside back in March of 2020. So that really doesn't appear that often. And when it does, it is usually worthy of consideration. That's why I put it on this chart. It doesn't really have anything to do with sentiment. It's just oversold. And you can see that it was warning of an oversold condition here, here, and here. And those were all pretty good indicators. But all of the other indicators that you see up here, these green boxes and these red boxes, they are all generated by these these three commercials indicators: the slow, medium, and fast, or the fast acting, slow, medium, I'm sorry, and slow acting indicators of commercials positioning. By the way, and so when this indicator, this is Larry Williams' Wilco indicator. He actually published the code back in 2005 in a book, 2005, in a book. Let's see if I can show you the book here. Trade stocks, commodities, and commodities with the insiders. That seems to be backwards, showing to you backwards. But anyway, trade stocks and commodities with the insiders, Secrets of the COT report by Larry Williams. It was published in 2005. It's not a cheap book, but it's a very, very good book, and I would highly recommend it. It costs maybe 40, 50 bucks. that could easily save your rear end just reading this book on one trade easily. And many of the concepts that I used on on the sentiment conditions charts were inspired by Larry Williams in his writing in this book. And he showed the actual formula in the book. It was around page 90 something, that you could use in Trade Navigator, and that's what I'm using here. And what this is commercials as a percent of open interest. This was Larry's idea on how to take this weekly data that comes out on Tuesday, the COT data, commercials positioning data, and get it to show us a little bit more activity and be a little quicker and show us some of what the commercials might be doing on a shorter term basis. That's a very simplified explanation of it, but that was the reason he came up with it, and it's, I think, very valuable as a shorter term indicator of what the commercials are thinking. And then this indicator here is the 6-month look back on commercials. So it takes the current positioning of commercials, which, as you can see, is a 77.52 reading on that chart, on that indicator. And it compares it with the most bullish and most bearish positioning of the commercials over the last 6 months, and shows you where it would be, they would be on that scale. This indicator down here is identically the same, except it is a 12-month look back, so it is a slower acting look back. I have found that by examining these 3 indicators, there's several important pieces of information you can glean from them. But I will say the thresholds here are 75 and 25. Those were Larry's thresholds suggestions. And Larry's also suggested looking at a 6-month and a 12-month. Not necessarily all in this one book I just showed you, but in some additional teachings that he'd done over the years in private sessions. The look back means how, for instance, on a 6-month look back, this is showing you on a scale that commercials are generally on the long side compared with their most bearish and most bullish positioning over the last 6 months. That's where you get this 6-month look back thing. So let's say over the last 6 months, we'll just draw you a quick diagram. Let's say that is a 100 on the scale, and that is 0 on the scale. And the commercials right back here were very bearish. And let's say that this is a 6-month, or let's call it a 1-year time frame. The commercials spend a lot of time moving up and moving down and doing things and with their positioning. But for a minute there, they've all the way down to the bottom of that scale during that 1-year period. And then at another time, they during that period, they were up at the top of the scale. So this is the highest bullishness they were during the 1-year look back, which is from here to here. Okay, that's 1 year. This was the most bullish they were, bullishly positioned, and this was the most bearishly positioned. So we ended up with a reading right here of 77. So that would be like ending up about right there. Okay, just the long story short. So actually, we're at an 81 on a 1 year look back. We're definitely in the top 20% of their bullishness positioning over the compared with their most bullish and bearish positioning over the last 1 year. Pretty close to that on 6-month look back. Now, let's say the 6-month look back was here. So there's the 6-month point, and you're only looking at this right here. Well, this point right here was the low end of the scale during that 6 months, right here. And this was the high end of the scale. So it's always comparing current positioning to their most bullish and most bearish positioning over an X number of month look back. So that makes sense? Everybody get that? Okay, good. And if they're over 75 on this chart and or under 25, I have it automatically put some colors on the chart. So if the commercials are positioned bearishly in the short term, you'll see green up here in this upper indicator. If they're positioned bullishly, I might have said bearishly before, but bullishy, if it's green. And they're also positioned bullishly on a 6-month look back and currently on a 12-month look back. So if I were going to generalize how the commercials are positioned on Dow Jones Industrial Average right now, it is on the long side. The commercials are positioned on the long side. When were they last bearish? When were commercials last pretty bearish on all three, on using all three different measurements? And the answer is right here. Right here. They're pretty bearish here. And matter of fact, even though price moved up a little bit more, they continued to be bearish on the 6-month and the 12-month look back. And that's when we got one of the larger pullbacks we've seen lately. And that was back in August and September of 2021. The percentage pullback at that time was about 6%. 6%. But notice, and they have spent some time bearish. You see these peaks and pink zones right here. They're bearish into this top. And right here, they were bearish right here. They were almost immediately bearish after the all-time high on January 5. So whenever this indicator, the fastest acting indicator, is either shows that the commercials are bullish or bearish, it throws up a thin either red box if they're bearish or a thin green box if they're bullish. If on a 6-month look back, it puts a medium walled box, and you can see that they've been showing themselves as bullish on this chart, and they've been in this green medium thick box ever since January 21. And then the slowest acting, the 12-month look back, gives the heavy box. So the commercials are positioned bullishly, and which means that they think that this essentially is a correction and that the market is going to move up higher. They didn't think that back here, did they? These are red boxes. And they didn't think that here. So these boxes up here, when they stack inside of each other, is when they are at their most powerful. And then the last thing I do is on this chart, the synthetic retail sentiment, I've got a 3-period simple moving average of my synthetic DSI. The reason I use that here is because regular DSI isn't available on the Dow Jones Industrial Average. And that smooth moving average of that, when it is sloping up, it is green, and when it is sloping down, it is red. And when it's red, it colors the candles red. And when it is green, it colors the candles green. And so sometimes, and very few people have ever felt like they could use a sentiment template like this as an actual signal generator. And I'm not going to say that it's that good, but it's close. Because, and I think what Larry Williams would say is, at this point right here, we had a thin red box, and we had a thick red box, and we had the DSI starting to slant down, and that created a red candle. So the first red candle inside of these two different thicknesses of red boxes was right there. And that was what Larry Williams would call that is a setup market. They wouldn't call it a signal as such, but look how that was one day before the top tick, before a substantial decline. Same thing over here. We got the thin red box, then we got the thick red box, and we got a red candle in there. So this is the first red candle inside of two different red boxes. That's bearish. And that was, there was a few days of messing around up here, but it eventually gave way to a waterfall decline. Then there were other times where you've got a thin green box, you got a thicker green box. You also had the ADX showing you that the downtrend was overdone. And then very shortly after all of those showed, you got a green candle. It was a long wick kind of reversal candle. And this would have given you, seeing this sentiment conditions template would have given you a lot of confidence in going long right there. And so I'm showing you exactly where I wouldn't call them signals. It's just that they're inflection points that are either bullish or bearish based on utilizing this template. And it's amazing how well they have done on the Dow Jones Industrial Average. So let's see how well they've done on something that's been a very difficult trade for the last couple of years. And it's an actual commodity. Let's look at gold to compare what we see on a stock index as opposed to an actual physical commodity. So we'll go to gold. And I just think this is an amazing chart, because using the exact system that I just showed you, when you get all the greens lined up, that's bullish. When you get the reds starting to line up in the boxes, and then you get a red candle, that's bearish. And then, one additional thing, on this one, we have the DSI. There's some additional indicators up here. You see these little small triangles here? That is when the DSI is below 15. And you see that bigger, more bolder triangle right there? That's when the DSI is below 10. So the triangles are letting you know where you're very close to a typical DSI extreme and when you are definitely in an extreme zone on the DSI, the daily sentiment index. Remember, on this day, there were only 8% bulls on gold and in amongst retail traders. Whereas on this day, right here, that day where it has a big red triangle, there were 95% of all retail traders were bullish. So let's look at how these indicators helped during what would normally be considered a choppy sideways market. So we're looking back at about mid 2021 here. So we got a couple of green boxes, and then we also had been seeing some downward movement, and the ADX was warning that the downtrend had become overstretched. Then we got our first green candle. Remember, that is based on the slope color of the DSI. First green candle inside of 2 green boxes. As a matter of fact, that was inside of 3 green boxes. That was a very bullish moment. And we got a nice move to the upside. Then we started getting some red boxes, some red candles. It was would have suggested at the very minimum, get out of your long position. Then we got an extreme dip on gold, extreme DSI reading, and we got our first green candle inside of 2 green boxes right here. Now see all the green boxes lining up. And the market was continued to move higher. But then all of a sudden, in this choppy market, it flipped and it all of a sudden became bearish. And we got our first red candle inside of 2 red boxes. And that was the beginning of a substantial decline. Then all of a sudden things were bullish again. The commercials are back bullish and we got our first green candle. This was probably the bottom tick candle, or might have been this one just before, but that was an incredible sign. All of the commercials indicators were lining up bullish just off of a 10 DSI, green candle, that's bullish, and away it went. And then we had a thick red box. We had a series of thin red boxes leading up to that. Then we got our first red candle, and that was bearish. This wasn't as strong of a signal right here because only the commercials as a percent of open interest were showing green, but it was still worth looking at because the commercials as on a 6-month look back and on a 12-month look back were both showing essentially what this is showing. It's showing more bullishness. And so that would have been a decent signal, and that went up for a while. Then there was a move back down in here, but notice the boxes remained green all the way until here. And there was a very powerful first green candle inside of a thick green box, inside of a thin green box here, bullish. Then it started going parabolic, and we started getting the warning from the brown zone. The ADX was over 60. I'll show you something real quick, and I'm still working on this, and I may change. So what I'm using to change the color of the DSI and the smooth DSI down here is an 8-period simple moving average of the DSI. And we didn't get our first candle until way down here. Even though we had ADX, we had DSI at 95, surely there would have been a way to get a little earlier warning than having to wait for the red candle there. And here's one way to do it. And I'll show this to you by taking the I'm just going to take the daily sentiment index off the chart. I'm going to put my synthetic retail on the chart. So this is my synthetic retail sentiment indicator. And when I took the other one off the chart and I put mine on, my synthetic retail indicator, it acted faster up here, and that's why I've got this little gray area and arrow right here. It changed its slope on the smooth synthetic retail instrument sentiment much quicker, and on the next candle after the top tick, it was a red candle, and that would have been a better spot to expect to jump gold to the short side. So what's the message that we are currently receiving? And I'm going to go back to the DSI so I don't forget to do that. I'm going to do it now. So if you were going to look at the message that this sentiment conditions chart, which our premium plan members get a screenshot of it every night, what is the message that it is giving us right now? Is it bullish? Is it bearish? Or is it neutral? Anybody? Anybody want to jump out there and say what they think the story is on gold right at the minute? Yes, I would say it's bearish. Of course, should have taken this word off of the chart first, but we're just off of this heavy red zone. Okay, and that means that all three of these commercials positioning indicators, the quick one, the medium acting one, and the slower acting one, were showing that commercials were short on gold. That you can just take that as meaning that the commercials are positioned in a way that where they're telling you they're expecting lower prices. And here's the reason it's not neutral, Greg, and here's why. Because even though they've moved up slightly above 25 line, that the dotted red line there, and dotted, they have barely budged above it. We just got the new COT report. This is not showing confident buying or confidence in an up move in the commercials. It's not enough. What other piece of evidence do we have that we're probably going to see further downward movement here out from these sentiment indicators? The answer is the DSI. Yeah, it's still high. It peaked at an 87 back here. So it got up to a 95 here. And retail traders were still 87% convinced on this candle right here that gold, 87% were bullish. Well, you can see what's happened since then. And it's closed today at a 66. There's a lot more room to the downside than there is to the upside here. This is, in other words, okay, and William Hornby he just mentioned in the chat, and William, by the way, is the individual that in July of 2017 sent me this book. That's when he started subscribing, July of 2017. He sent me this book, and we've been discussing all of the ins and outs back and forth in email ever since. And this is essentially culmination of a lot of what we've been putting together. And it's kind of what William has been asking for, which was a visual representation that you can look at pretty quickly, and you can pretty quickly make a decision on, and you can see visually how the commercials were positioned. And Larry Williams always says, you want to trade with, that's what it says, trade stocks and commodities with the insiders. You want to be trading with those guys, not against them. They're the biggest influencer of price movement, especially in commodities. And so you don't want to be trading against them unless it is a very, very short-term trade. And probably not even then, really. So I would say that the conditions are still bearish. We still have red candles. We don't have any new green boxes. We're not going to get any green boxes out of the 6-month or the 12-month for a long time. And remember, here's what commercials do. When price is moving up, they're making money. The gold miners making a lot of money as gold was priced higher and higher and higher, but to protect themselves as it got ever so stretched to the upside, they were building hedges. They were adding to their hedges so that when the inevitable and kind of went parabolic trend ended, they would not, they would have some protection for their business. And so if this thing starts moving down, let's say it does, let's say we're in a third wave, let's say this is 1 and 2 and we're in a third wave down, you will start to see the commercials start building a position, but it really won't be meaningful as far as when a turn is expected back to the upside until they get up above the green line. They do start early, and the reason they start early on hedges is trading is as huge as their accounts are. It isn't how they make their money. It's how they protect their business. They make their money digging stuff out of the ground and selling it, and they do it 24/7, 365, pretty much. They're always net sellers. That's what they want to do. But sometimes they won't be able to sell for as profitable of a price, and they want to be positioned in their hedging account in such a way that that can offset some loss of profitability during those periods. But yeah, this is going to have to go, I think, quite a bit lower before we see the commercials positioned in such a manner we can start getting bullish again. You know, there was a request to look very quickly at silver, and you can see where these I won't call them signals, but where these setup markets came in once again on silver really well. Bullish, first green candle inside a bunch of green boxes. Bearish, first red candle inside of some red boxes. Bullish, first green candle inside of multiple green boxes. Bullish again, but all of a sudden now it's turned bearish. You see the color of the boxes up here we're seeing? They're red. That's not good for a bull. It's good for somebody who's short. And guess who's short? The commercials. So the price of silver is coming up, but guess what? They positioned heavily short all the way back here. You first got your first sign of it with that thin red box right there. It continued higher. Then you got a medium red box, and then you got a thick red box. Now all of a sudden you got a red candle inside of the thin, medium, and thick red boxes. Notice that this little up move right here was only accompanied by a thin green box. So the commercials as a percent of open interest was really the only commercials indicator, the fastest active one that even responded to this little move to the upside. The 6-month look back and the 12-month, they weren't budging. But I think you can see when you get the green boxes, you can see when you get the red boxes, you can see when you get the green, you can see when you get the red. It's so visually easy for me. I've been looking at these for a while to see how the commercials are positioned just by looking at these boxes up here. But we also have these, which are handy, because once in a while you have a situation where they're heavily long, and then you start to see a little change of behavior, and that can be meaningful. So I've left those indicators on the charts, as well as the DSI. And I'll show you one other example and I'm probably going to continue to tweak this a little bit, because it would have been real handy to get a sell signal like one day after that top 10 candle. Don't you think? That would have been handy. Well, look at what, if we use, instead of the DSI, if we use my synthetic retail indicator instead, that's exactly what we got. We got our first sell, a candle inside of two different red boxes right there. And it would have suggested at that time getting short about right there. Well, the gold has spent 99% of its time underneath that line over the last couple of months, and now it's really heading lower. So the one thing I will show you, look at my synthetic retail in sentiment. It's already down pretty low. And I'm going to put both of those indicators up there on the same chart, the DSI and my synthetic retail, and they're both incredibly valuable, because this is what's showing us that they're really only the retail traders are only back to 50%. They're back to neutral. Commercials are still heavily short. There's a lot of room left to go for them to continue on lower. So what time is it? Okay, we've been going about an hour and 15 minutes. Any questions? And so we're showing these every night. I think that active futures and traders, as well as longer term investors, should find these charts invaluable. And William has told me that you really can't find anything like them anywhere else on the internet. And these trades are worth thousands of dollars. And it only costs $100 more a month to get these every night than it does, just getting my weekly counts webinar and my Elliott Wave and Hurst screenshots. Let me show you one other thing that I think has been a perfect example of what these screenshots, the sentiment conditions screenshots can provide to you. So as many of you know, I build Elliott Wave counts, and I incorporate Hurst cycle analysis into my Elliott Wave counts. And you can see that my combined Elliott Wave and Hurst roadmap has been bullish on the Australian dollar against the US dollar. However, I have been putting an additional note on there that says sentiment conditions do not support additional upside. And that's been the case since the beginning of this downward movement that started back early in April. Let's see what the sentiment conditions have been telling us about the Australian dollar. Well, that we had a setup market, I won't call it a signal, but boy, it's close, for bearishness. Looking at the commercials positioning, I mean, they are getting they've almost fully bearish on it, even on a 12-month look back. And ever since it's 73 on the DSI. Now, you might have thought, well, 73, the DSI can go a lot higher than that. However, the commercials were already telling you something. And this is something I've been showing in my weekly webinars, is that watch out for this by Elliott wave count at Hearst and what Hearst is suggesting, because the cinema conditions did not support it. And look what happens. The commercials won. Kirk says, if you wanted to use ETFs that correspond to the futures rather than futures, how similar would the results be? Well, they should be very similar, Kirk. For instance, if you want to trade GLD or options on GLD instead of trading the futures market, these charts would be just as valuable to you, like that gold sentiment chart, as it would be to a futures trader. As a matter of fact, you might have less worry, overnight worry, because the future, a single futures contract can be, you can get behind the 8 ball pretty quick on those. And if you're using options or different ETFs, you might have a little bit more granular control over your risk and depending on how risk averse you are. I'll tell you, futures traders need, I think, big accounts, and they need balls of steel in order to do what they do. And the ETFs do give you a way to granularize that and maybe build a position same way. And it's very similar to what the commercials do. Build a position over time. And if you were doing that, as long as you don't misestimate how many shares of that ETF you're buying or whatever you're doing with them, that's going to be the secret. You don't want to move too fast and put on too big of positions. And so that takes a little bit of getting some understanding of about how much, you have to do a little planning as far as how far this thing could go against you, and you'd still stick with it. Any other questions? Options and ETFs sounds more me. Futures broker house are also in common. Planting trees in Canada. No, you like finding one here. Yeah, you don't have to do it. I think learning options and how to trade options would be fantastic way to, and these charts could be very valuable on options, and options do allow you to not only control your risk up front, but make adjustments along the way about how much at trimming some of your risk without completely throwing the baby out with the bathwater. You might still be correct on your idea. I mean, how many times have you been correct on an idea, but it puts you through a painful situation first that you couldn't stand, and you dumped out of position, then it did exactly what you thought it was going to do. Anybody that's traded for very long has had that happen many times. And there are ways in the options that you could learn to control that and make adjustments along the way. That's not really part of what I do here. What I try to do is I try to give traders tools that are extremely useful. And in this case, with the sentiment conditions, the new sentiment conditions screenshots, I think what I've been able to do is provide something that might take you a very long time to come to these same conclusions, as opposed to just looking at a chart and being able to determine pretty quickly what's going on. So I would like to thank William again for all his enormous help on putting all this together. William has been on William Hornby, that's a long-time subscriber, a student of Larry Williams' teachings for a long time. He's even been to some of his private getaway training sessions for a week and that sort of thing. And so he is constantly bringing that knowledge my way. And I really appreciate it, William. And I think Larry Williams is probably going to watch this recording. I want to thank Larry Williams for all of his tremendous research over the decades into how to look at these things. You know, once you understand how important the commercials are on many of these items, you realize that it's probably not a good idea to trade without knowing what those guys think and what they're doing. Any questions? I really don't want to do that in this session. This session is about the things that are particular to the premium plan, which is the automated momentum signals and being aware of, keenly aware of sentiment conditions on as many items as possible in the markets. That's all I'm going to have time for to do on this. And this is also going to be kind of an educational video I'll put up on my site. So let me just say thank you, everyone, for joining me. Hope you have a great rest of the week in the markets. I know it's very volatile times right now. I did show you one little clue earlier on the S&P that it could experience a loss of momentum at this time, although it's too early to say for sure, a loss of momentum to the downside. Thank you so much, Tobe. Very nice words. Have a great rest of your evening, and we'll see you guys on the email and in the webinars and screenshots and all the rest of the things that I do. Have a great one. See you later. Bye-bye.